it's probably a good idea to take a moment and step back and look at the three types of entities we've been discussing so far. We've looked at partnerships, and in particular, the form of partnership that is most commonly used, the limited partnership for business enterprises. We've looked at corporations, also sometimes called C Corps, as opposed to S Corps, and I'll mention what an S Corp is in a moment. And then finally, recently we looked at limited liability companies, right? And here's a chart that I adapted from a chart that Practical Law has called Choosing an Entity Comparison Chart, right? And the point of this chart is to sort of summarize the key differences, the key traits that each of these three types of entities have and their differences, so that someone who's coming to you and says, hey, I want to start a business, you can show them why one form of entity may or may not be better than another for whatever purpose the client has. So let's go through it for a second. Here we have, well, so who are the owners of each of these entities? A partnership, we know, is formed by two or more persons who've come together to pursue something, a business for profit. So we have these people called partners who are the owners. In corporations, you have one or more stockholders or shareholders, depending on what the state statute calls the evidence of ownership, stock or shares. And then in LLCs, you can have one or more members who are similar to stockholders or shareholders. These are the folks that own the equity interests in the enterprise. So those are just the different names for the ultimate owners of those kinds of entities. And then, so how can those ownership interests differ? How does it get structured? Well, in a limited partnership, so as opposed to a general partnership, in a general partnership, everyone's the same, right? Even Steven, they all have equal rights to participate in management, equal rights to participate in the economics, unless the partnership agreement says something different. In a limited partnership, however, we have two categories of partner, a general partner and a limited partner, and typically the limited partner is passive, while the general partner is responsible for the management of the entity. All right, so we have these two categories, and we learned we have to be careful if we have limited partners that they not participate in the active management of the enterprise, because by doing so they would be giving up their limited liability position as a limited partner. In a corporation, we are given more sort of fixed building blocks, if you will. We are supposed to use a thing called common stock and then a thing called preferred stock that have sort of set features to them as the way of creating economic interests. Whereas in a partnership, we can simply write exactly what it is in the agreement, in the partnership agreement, that each person's entitled to. We can say, oh, this person's entitled to 40%, this person's entitled to 60%. In a corporation, to get to the same result, we have to play with the blocks we are given. So if we want to give 40% to someone and 60% to another person, we have to make sure that we have 40% of the common stock being distributed to that person and 60% being distributed to the other person. We have to play with the pieces we've been given. We can't just write exactly what we want. But, and similarly to a partnership, a limited liability company, we can simply write the operating agreement, as we saw, any way we want. And we're going to see examples later of how far we can go to be very partnership-like in simply defining different rights being granted to different people however we wish. But none of that is really that significant, because while, yes, there are different ways to approach it, and there are different drafting requirements and different tools you have to use in writing the different kinds of agreements that you use, in the end, you can get to the same result, right? So if you want to give X percentage to somebody in a partnership, you can do it one way. If you want to do it in a corporation, you can do it a different way using stock, and same with the limited liability company. So actually, while there are different ways that you have to use, at the end you can get to the same result. So it's not a significant difference. Of course, the documents that are specified in order to create these different forms of entity are different but again, not terribly so. There's not that much of a difference between a certificate of formation for a partnership and a certificate of organization for an LLC, or even for that matter, a charter for a corporation. But they do have their own individual idiosyncrasies that you are aware of. But here's where we're starting to get to the nub of it, right? So why would you pick one of these entities over the other? And probably the biggest factors are tax, liability, and management, right? Tax, okay. So a partnership is not a separate entity for tax purposes. It's a pass-through entity. And what does that mean? Well, we've mentioned it already, and we're going to look at it much more closely a little later. But what it basically means is that the business itself, the entity itself, does not pay tax. That what happens is the income and expense that's incurred at that level then gets recognized by the owners, and then those owners pay tax as if it were their own individual income or expense rather than the entity. So there's what we say sometimes is that there's only a single level of tax in a partnership structure, unlike the corporation. In a corporation, there's two levels of tax. So whatever the business earns, there's tax paid by the business itself at the corporate rate. And then to the extent that there are distributions by the corporation of its earnings through dividends or otherwise, that then triggers a second level of tax that's paid by the stockholder. Okay? And so generally speaking, it is, from a tax point of view, beneficial to be treated as a partnership or a pass-through entity or a disregarded entity, another phrase we sometimes see. And so there is an incentive to be a partnership versus a corporation from a tax perspective. That incentive is not as strong as it may sound. There are reasons, and we can explore them later, that a corporation may be just as good. For example, if a corporation is expected to lose money for a significant amount of time, it may actually be better to use the corporate form than to use the partnership form, may be more valuable. But again, generally speaking, people prefer to not have two levels of tax. And an LLC is great because an LLC is a form of entity that allows you to do what we call checking the box. The IRS says an LLC can be treated either as a partnership or disregarded entity or as a C Corp. And it's up to you. You just check the box. And when you check the box, you decide whether or not you want to be treated like a corporation or whether you want to be treated like a partnership. So it's sort of a best of both worlds kind of option. Liability. We saw that liability is an issue in partnerships. Particularly, general partnerships are definitely not very protective. Limited liability can be achieved in limited partnerships, but that's at some cost because limited partners can't participate in management. Otherwise, they give up that liability. However, in a corporation, stockholder liability is clearly limited. All right. So even if that stockholder then is also an officer or a member of the board of a corporation, that by being such, they do not expose themselves to general joint several liability. They still benefit from limited liability. Similarly, the same kind of limited liability is available to LLCs. So on the liability side, corps and LLCs are preferred. On the tax side, partnerships and LLCs are generally preferred. So then the question of management. Well, we know how partnerships work. Basically, the GP is the manager who can then delegate to an agent. In a C Corp, we have this thing called a board, which in turn designates officers, right? And then in a limited liability company, we can do it any way we want. We can have individual owners, the members, run the enterprise. We can have a board-like structure or a manager structure who's separate from the members. And all of those people can in turn employ agents, right? And so in terms of the flexibility of how you structure your management, an LLC is by far the most flexible. And it is flexible, but at the same time does not give away the benefits of limited liability like you may do if you get too creative with a limited partnership. So from a management structuring point of view, LLCs are definitely the preferred vehicle. So I would say the bottom line on all this is to say you gotta come up with a reason why you wouldn't be an LLC, right? So in almost every case, your first assumption should be, ooh, the best choice is going to be an LLC, and that's because it has the best tax treatment, or you can, if it for some reason you want to be taxed like a corporation, you have that option by checking the box. Right? You get the best form of limited liability. It comes with the least restrictions on how flexible you can be in designing your management structure. And in fact, the other thing it comes with is you have the least formality, right? So remember the piercing the veil cases, some of the criteria for piercing the veil included not observing corporate formalities. Well, in the limited liability company, you don't have to observe particularly any set of formalities, and if you don't threaten your status as a limited liability entity. So for all those reasons, you ought to assume that absent some compelling reason to the contrary, limited liability companies is the way to go, right? Now, what could those compelling reasons be? Well, here's probably the biggest one, and that is LLCs are generally speaking not publicly traded, and limited partnerships are generally speaking not publicly traded. And the most common form of entity for a public company, meaning one whose shares or equity interests are traded on a public stock exchange, is a C corporation. Right? In fact, there's some perceived wisdom that, and this is apparently more true on the West Coast than it is on the East Coast, that if you believe that your outcome for your startup company is that it's going to be a publicly traded company, you might as well start out as a C Corp, because that's what you're going to have to be when it comes time to register with the SEC. And so on the West Coast, at least, there's a general perception that venture capitalists insist that even the smallest company, if they're going to work with a venture capitalist, has to be a C Corp. Because why not start out with what it is you expect to be down the road? It's sort of a sign of taking seriously your ambition to be a public company. I think that's a little overstated, and certainly in the East Coast, there is a tendency to let you start as an LLC when it's attractive to have pass-through taxation, and understanding that you're going to convert when the time comes to go public. But since most companies never make it that far, why insist that you start that way? But okay, so if you are planning to or imminently about to be a publicly traded company, you have to be a C Corp, okay, for most companies. There's some rare exceptions. So you might as well start as an LLC, right? Might as well start as an LLC. Okay, well, when would you ever want to be an LP? And the answer to that is less about capital raising and more about tradition. There are certain industries in which the limited partnership form is historically been the most common one. And interestingly, the industry that comes to mind is the investment management industry. So hedge funds and private equity funds tend to be limited partnerships, as do real estate and oil and gas and those kinds of partnerships or investment partnership structures. Even the word investment partnership includes the word partnership, right? So, and the reason why they haven't switched to LLCs is not because LLCs wouldn't work; they would. And more and more, you're seeing some of these things set up as LLCs, but it hasn't switched wholesale because investors in these investment vehicles are so used to dealing with limited partnerships and have invested so much energy in understanding and becoming comfortable with the standard documentation that creates a limited partnership in those industries. They just don't want to change. They don't want to reinvent the wheel. They don't want to learn new stuff, right? So even though an LLC would probably be better, and certainly would have been the choice had we been starting from scratch. History is binding us to this tradition of using LPs. But, so absent going public or absent being in an industry where there's a strong history, LLC is probably the way to go. Now, some people say that the reason why LLCs, they're hesitating to switch to LLCs, has been that there's a lack of history around LLCs, that the law is not well developed, that these are relatively new statutory creatures. In fact, 10 years ago, no one ever used them very often, and now that's not so true. But there's not this same depth of legal interpretation out there. There are not that many court cases. There's less of a certainty around how the law will get interpreted, and so corporations may be better than LLCs because they're better vetted by the legal process. But that is absolutely changing. People are becoming much more comfortable as time goes by with the LLC form, and I would say they've certainly eclipsed the limited partnership, and will soon be eclipsing, particularly for small privately held businesses, the C Corp form. Now, I did promise to mention what is an S Corp, right? So sometimes you'll see in the list of different entities, and you would have if you went to the practical law choice of entity table, you'd see another column for a thing called an S Corp. An S Corp is a corporation, so you form an S Corp just like you form a C Corp by going to the state statute process and forming a corporation. But an S Corp is different than a C Corp because of how it's taxed. The IRS recognizes two different types of corporations, or these two different types, C and S Corp, and an S Corp is treated just like a partnership. So it's a corporation for corporate law purposes, state law purposes, but it's a partnership for IRS federal tax purposes. And so in a way, it's sort of like a limited liability company in that you get the benefits of being a corp, state law benefits like limited liability, but you get the benefits of pass-through taxation like a partnership, which is just like what we said was so great about LLCs. Right. Now, why would S Corps were very popular before the rise of the LLC, right? Especially for small family-owned businesses. You'd find a lot of people, especially accountants, telling you, oh, you got to be an S Corp. Now that LLCs are out there, well, they are probably a better choice. And most importantly, because you get the exact same benefits you were looking for from an S Corp in an LLC, but without all of the restrictions. So S Corps have very significant restrictions. They can only have 100 shareholders or less, and all of those shareholders have to be individuals. They have to be people. And so that, for example, would eliminate your ability to take in money from some kind of fund, right? Some kind of investment firm. And so why limit yourself that way when you can get everything you want by being an LLC? So I didn't bother to include S Corps in this chart, but I just wanted you to be aware that that's a concept that sometimes you'll run into.